Yo, yo, yo. Welcome back to another Thompson's Two Cents. Happy Friday to all of you out there. I'm back from a week in Connecticut, and boy, oh boy, I'm thankful to be back in South Carolina. I don't know how you guys live in the Northeast in the winter. I'm telling you, my skin gets all dried out. Got to have all these jackets. It's a pain in the butt. So happy to be home. Happy to be on another episode of Thompson's Two Cents. And today we're going to talk through the market, kind of a hodgepodge, but the theme of this is going to be the ugly charts, the messy charts, and the charts and areas of the market that can maybe save it, the saviors, as you might say. So that's what we're going to dig in today. See the chat popping off. Thanks for those that are in the chat. I will say I want to do a Q&A next week. So in this segment, I'm going to do a question and answers. So I'll answer your questions. So leave a comment for any questions you have or any tickers you want me to take a look at. Also specify the time frame, whether you're 6 months, 3 months, 9 months, daily, weekly, monthly. Just let me know because then I'll try to break those down in the Q&A we do next week. So let's go ahead and get into it today. So I want to start here where I try to start every single week because I'm a process-driven investor. I think having processes in place allow you to see shifts in the market. Right. So if you're pragmatic in your analysis, you look at the same data over and over again, and then your opinion changes based on that data. If you're not, right, you have an agenda, and then you go and find data that supports it. So we're going to start here. It's just a zoomed out chart, S&P 500, right? We have some weekly candles here. And on the bottom panel, we have S&P members that are above their 200-day. As we can see here, we've seen this bottoming 3 times now, kind of 3 past cycles. And the thing I want to point out here is how breadth recently in this cycle hasn't been able to really sustain above 70. 70 might be a little bit of a stretch, right? That might be me being a little picky. But you've seen in these other sustained uptrends, we've had this breadth not just improve, but then follow through to the upside, right? It's like a boxer just landed jab, jab, jab. We've landed some good jabs, but we just haven't had that finishing blow to really see that breadth above 70. And so that was kind of something that if you were looking at the market internals may have given you a little way, not to be cautious, but just to understand your positioning in the market, understanding that being overly exposed from an internals perspective might not have been a smart decision. So I wanted to start here. It also kind of provides context that, yes, I think we're in a 3, 4, 5% drawdown at the moment. Nothing significant at the moment. So just kind of zoom out and have that context because the market has an upward bias. So it's not like I'm making some grand statement here, but just if this is your time frame, understand that, yes, shorter term, it's been messy and ugly, but longer term from an S&P 500 perspective, we're doing just fine. So let's kind of get into the theme of today's show. I'm not going to act like I'm one of these people that hates macro analysis, hates economic analysis, hates fundamental analysis. I am a CPA by trade, and understanding that CPA accounting kind of backgrounds is kind of the language of business. And I think I got my CMT to kind of understand the language of the market, which is charts. And there's times when those align and there's times when they don't align because there's not a one-for-one translation how like a lot of people think about it. Like this company is performing well, therefore the stock must perform well. It doesn't happen that way. And it's really price that pays this. So when you can kind of blend the two together and understand when what the economists are saying and the fundamentalists are saying is aligning with the charts, there's probably some more conviction you can have in those areas or just more information to process. So thinking about the K-shape, this says recovery. I didn't make this chart. It's a chart I pulled off the web, but just K-shaped economy in general. I agree with that notion, and we'll get into why. You look at the ugliest charts in the market, a lot of it are in this bottom K area, the cyclicals, some of the small caps, right? Some of the industrial names. So that K-shaped retail names of the market kind of led to kind of the breakdown we saw recently in those kind of upper K areas, technology and large cap firms. So starting here with the chart, I love to look at every single week. Like I said, being process oriented, we have home construction and home builders. Okay. This is, as I mentioned, the bottom half of this chart, right? Because these are people who are trying to buy homes because new home construction and home builders aren't for people who already own homes, which tend to be the wealthy, right? Because they've already built their assets up. These are people trying to build their assets to a degree. Whether or not you think a home is an asset or not, I'm not trying to debate you at this moment. What I'm trying to note here is that home builders are ugly. They were struggling. This 200-day, as we can see in the chart, has kind of turned into resistance. And we had a big update today, but guess what? And I'll highlight this in some of my work I'm going to do tomorrow. A lot of big updates come in down markets, right? And down trends. So until you see follow through in something like this, home construction and home builders don't look great. And so I would just say, if you're a trend follower, this is an exception, not the rule. Today was the exception, and you see big moves in downtrends. So this is one of those charts I want to see get repaired if we're going to see that bottom K kind of recover and kind of help us, help the top K to a degree, if you think about it that way. But just in general, not be a drag on the market. Next area I want to look at, retail, right? Consumer discretionary, consumer spend, retail, right? These are everyday folks are buying items all the time, right? 70% of GDP is consumer spend. And so when you see something like a 90% equally weighted retail ETF, which go ahead and, oh, I don't like this name. I don't like this name. There's 90 names in here, guys. Like, it's not like I'm cherry picking an individual retail stock that's doing poorly. It's 90 names. Okay. So 90 names aggregated together, 90 individual notes have broken down, but similar to those home builders, are kind of sitting at this 200-day. So an ugly chart, but now we have that potential for this RSI divergence, right? Where you have higher low in momentum, lower low in price, basically saying price is going down, but it's going down slower, right? So think about physics. Something has to stop falling, right? Slow down, then stop falling, then reaccelerate up. So that's what we're seeing. We're seeing a deceleration, right? So deceleration leads to reversal, then leads to acceleration. So price has to kind of follow that dynamic. So we've had that deceleration. It may be a slowdown here. Let's see if it can reaccelerate, because you have this 200-day that it's serving well against. And if you think about it, standard pullback or a healthy pullback is essentially to the 200-day. So we've seen that now in home builders. We've seen that now in retail. Not that I necessarily classify it as healthy, but just as a generic way to think about it. Now we're kind of getting to these like nut up or shut up levels in a lot of these areas where I don't think it's smart to press shorts here. I think you should have already pressed the shorts if you were going to press them. And speaking of shorts, this is something I wrote about a couple weeks ago. I believe it was on Halloween or the day before Halloween. I said, Bitcoin looks spooky. And then I posted on November 11th this chart and kind of showed the failed breakdown, failed recovery, the real breakdown about to start. That was November 11th, that the real breakdown. I was like, if you think about shorting, you want to do it when you have RSI kind of failing and you have clean risk reward to the downside. In bull markets, you don't want to necessarily do it on the follow through, because the follow through could be capitulation. Like yesterday, could be capitulation because now you have an up day. We don't know yet, but you kind of want to short into the highs if you're shorting, especially in a bull market. That's how I tend to think about it. Because by the time it gets to those levels where you think it's a good short, it's typically where it's going to bottom if we are still in a bull market, which I believe we are, based on a lot of data. So these are the ugly areas of the market. That's that bottom K that I'm kind of talking about. Another one, consumer discretionary, similar. Okay, so those 90 stocks, you might not like those 90 retail names that I brought up earlier. Okay, well, consumer discretionary has Amazon, has Tesla, has Home Depot, has Lowe's, has a bunch of other brands that people love. And similar, right? Above the 200-day, below the 50-day, failed breakout, which we've seen over and over and over again in the market. And now it's looking maybe to find some support here near the 200-day. But I would be cautious in the fact that we don't know yet, right? You got to see follow through in these types of charts. And on a Friday, it can be enticing to try to call a bottom because, capitulation yesterday. And then, oh, we had an update today and it's a Friday and we're heading into the seasonal period of the year where stocks can get stronger and sentiment is in the dumps. Yeah, there's always going to be a story to tell, but we need price to show us that story first. So consumer discretionary, another K part of that economy that is kind of struggling right now. Next thing I want to talk about equal weight, right? So kind of moving from the ugly to the messy, right? So we've seen that kind of bottom K area of the market. And then think about equal weight and all these next areas kind of as that median, right? The middle class, right? Which people will say is shrinking. I'm not here to debate that. What I'm here talking about is kind of what I talked about is you don't want to short the hole in a bull market. We had the failed breakout. That's where you short. Now we're running into a bunch of logical support in something like the S&P 500 equal weight here, where we've had a decent correction. We've had some sentiment reset to a degree. We had NVIDIA report earnings, and then we saw a bullish or bearish engulfing reversal day yesterday that got everyone pretty spooked. So us finding support here would be something that would make sense and be logical, not only from a price perspective, but from a narrative perspective in the market. And I think we'll get to it in a little bit. I think the saviors will show us where that can kind of come from. Similarly, right? Talking about that equal weight, kind of the average stock. This is one of those reasons you guys know I've been sharing this for weeks is why I didn't believe in adding to the relative strength that we saw in the market because I thought the relative weakness outweighed the relative strength. Because what's going to happen is, especially when you look at some relative ratios, if you don't look at the absolute ratios, you might not see that that one area of the market that is showing relative strength is actually the exception, not the rule. And that's what we saw. We saw home builders roll over. We saw software roll over. We saw Bitcoin roll over. We saw retail roll over. And people were talking about this one area of the market that's holding up, which is great, right? Like it's an observation to make. But observations are an analysis. You then got to take that observation and apply it to the context of what else is taking place in the market. Do that via breadth. This is breadth, right? The Russell 1000 equal weight represents over 93% of the US equity market. So when we see this failing to break out, a failed breakout, you got to understand that those exceptions probably shouldn't be being pressed at that moment. The other thing I'll highlight here too is with these messy charts is we are getting to these logical support levels. So it's this combination of the market needs to repair itself. This probably isn't the position to short. And so that's that no man's land or don't press it at the moment in the market. And that's okay, right? Everyone wants to call a bottom. Everyone kind of wants to be on one side of the fence. But what we've seen is we've seen the bearish data grow, the bullish data shrink. And now we're at this point where if it is a bull market, the bearish data is at a point where it typically will reverse. So, and that's typically a buy signal because you'll see weak levels, reversion from weak levels in a bull market is when you want to buy. And so we'll get into that, but this is another messy chart. And then the last messy chart, which will kind of get us into the saviors, I believe, in the market, is tech, right? I think we all know this by now that technology dominates S&P 500, and it's trading sideways. It's messy. It's another messy area of the market. And so we will need this to dig in and kind of follow through if the market has any chance of kind of going higher through year end. Because the Mag 7, once again, you can look at an individual name if you're trying to tell a story, but why not just equally weight all 7 of them and understand that, hey, they're just basically chopping sideways. And this represents 33% of the S&P 500. Got a couple more here. Financials, similarly, just messy, chopping sideways, but coming into support, right? So don't short the hole here. Kind of let it be what it is and let these financials maybe chop sideways a little bit, maybe reverse back above here. But this AVWAP is that opinion line I talked about. So we might see a little spook below the 200A and then a follow through. I don't see capitulatory evidence yet, but I think we're probably closer to that than we are to this being, a bear market. Industrials, another messy one, but once again, kind of breaking down from this range, but finding support near those April low AVWAPs and then the 200-day. So if you think about it from a risk reward perspective, yes, the market may look messy, but what are you going to do? Press a short where you have maybe 2% to the downside because so logical and potential support sits below it? Doesn't really make sense. So that's where I think a lot of these charts are just kind of showing you they're in this no man's land. And so let's kind of get into the saviors, right? What can save the market? We know it's a little bit of tech, and I think a lot of this is stemming from the Fed. I think a lot of this, if you kind of look through the charts, is stemming from some maybe policy driven positioning by the Fed in terms of them being pretty hawkish in when we look at that K shape, you're seeing the bottom K is struggling, right? You're seeing housing struggle. And we know housing is such a significant part of the market. So that K, you can't close the K by the rich pulling down the top part of the K. That's not going to close the K because the top part of the K employs the bottom part of the K. So if the top part of the K comes down, the bottom part of the K is going to go even lower. So what the Fed has to do is their mandate is employment and inflation. It isn't to get rich people to be poor, right? It's to get poorer people to have jobs. That's a big part of their job. So when you think about that, we'll get into a interest rate chart here in a minute. But when you think about that, actually, let me just get to that chart. When you think about that, this is where bonds come into play. So we've had a lot of failed breakouts in bonds, and I'm looking at a longer term bond. I know the Fed controls the shorter end of the bond, but when you think about this, these failed breakouts that we've seen in treasuries, right? Once the failed breakout occurs, and we've seen this now recently, this one, bonds and stocks kind of corrected together, tells me that the market is saying, hey, we don't like the fact that the Fed is a little more hawkish than we would like here. So I think the market is kind of telling the Fed, right? Hey, you guys should be trying to cut rates. You guys should be continuing on a path of rate cutting, not necessarily stalling that. And I think one of the saviors can be bonds from the perspective of yields, right? So yields going lower, bonds kind of going higher. And this is one of the charts you can keep an eye on. We still have this base in play from this recent high AVWAP and this 200-day simple moving average. You can see we still have this reversal in play. We didn't get oversold. RSI is staying above 40, which if you think about ranges for RSI in a trending market, instead of using it as a mean reversion tool, this is something that I think is important to the context of the market rebounding is bonds and yields going lower to help that K bottoming of the market, help housing, help retail, help discretionary. So let's go back here. I wanted to walk through a couple more charts from the perspective of the saviors of the market and why, even though there's ugly and messy charts, this isn't the point where I think you should be pressing shorts. So one of my favorite breadth model works that I've built out is looking at S&P 500% above a 20-day moving average. So there's nothing special about 20-day moving average other than it's like a month of data. So the past month of data, it's a little bit shorter term here. But what I want to highlight is the fact that typically when we get percent of stocks above a 20-day getting around this 30 level, it's typically shorting the whole. So if you get short here, you typically don't do well. And so that's the signal that like, hey, shorting downside follow through in a bull market isn't that smart. It doesn't tend to work because that's when you see capitulatory evidence. And so what we see here is we've seen that that shorter term breadth is kind of reversing to the upside. So shorting the whole here doesn't make sense to me. I think we get back above this 50-day. That would be a clear level to kind of manage risk against. We want to see follow through. This is only one up day, right? So we want to see follow through in this to kind of get more conviction to the upside. But being below a 50-day, in between a 200-day with percent above a 200-day around 47 and percent above a 200-day around 50, you couldn't be more middle of the road than that, right? So that's how you kind of got to think about it. There's not a reason to be extremely one-sided at the moment. Shorting a little bit higher would have made more sense than shorting right now. Another chart that kind of shows that similar thing here, we have the S&P 500, the S&P 400, and the S&P 600. S&P 600 is small caps that make up the S&P 1500, right? 400 plus 600 plus 500, 1500. Clap for my math skills. Shout out to math. S&P 400 is those mid caps. As you can see here, similarly, don't necessarily want to be shorting the whole. Breadth is at washout levels where we've seen it rebound. So we want to see two things. It might be at washout levels, but the bulls also need to see follow through. So until we see one of those two things where we see bullish follow through, there's no real reason to have a ton of conviction at the moment. And I talked about this a couple of weeks ago. how to have conviction. This is not the moment to have a ton of conviction on positioning from a technical perspective. And so just be cautious here when it comes to these shorting. Is there a lot of bearish data? Yes, but I don't necessarily think this is where you push the gas on those shorts. Something I also want to see here is RSPD, so discretionary versus staples. You can see it's trying to reclaim a key level, but if it doesn't, and this kind of falls down, right? You kind of see this follow through to the downside. That could be another sign that, hey, there's actually more room to the downside in the market. But it kind of finding support here would be key because that's a key level for it to recover against, but it's still guilty. The further down we get, the more follow through you need to have conviction unless we have capitulatory evidence, which we just don't yet. And so in terms of the saviors, we know one of them, tech, 33% of the S&P 500, right? We thought maybe NVIDIA would save it, but it didn't. The thing I'm watching here is this breakout AVWAP level from July. So if we can get back above 275 on tech, we can see 2, 3, 4 days of follow through. You have pretty clean risk reward to maybe, hold your nose, a stinky buy, right? A stinky buy kind of oversold conditions on a long-term uptrend, which you would have in tech. So tech sticking it here would be one of the early signs that, hey, it's time to press the gas again on some longs, right? Long-term uptrend, buying oversold on longer term uptrends, right? A big component of that is NVIDIA, which we talked about this last week, but if NVIDIA had good earnings numbers, that might have been something we've seen, which they did. But what matters is the reaction. So what the market is telling you here by NVIDIA beating and tanking the following day, it's not telling you that NVIDIA sucks. It's telling you it's more worried about something other than earnings at the moment, which is why I talked about the Fed. It tells me the market is more worried about the Fed than it is about earnings at the moment. And so that's why that chart I shared of bonds is much more important. So NVIDIA can stick it here, this breakout AVWAP. If NVIDIA can stick it here, kind of have this lower shadow, so close closer to the highs than the lows for the day, that would be another sign that we're seeing the savior of the market follow through. Amazon, another huge component. This is an example where I was telling you guys, maybe not the smartest levels to short against because we're running back into that 200-day that served as support. So if we see follow through here, it could be one of those stinky tactical buys, but you might run into resistance again when you get to the top end of this range. So if we have a messy market, trend follow, that's the enemy of trend following, right? The enemy of trend following is mess because ranges occur, and ranges is the exact opposite of trends. Trends is the exception to the range, right? It's breaking out of ranges. So if we're going to be in a rangy market, you can trade the ranges where you trade the bottom level to the upper level. But for a trend follower, you might trade the bottom level using the longer term trend as your signal. So intermediate term mess, buy the bottom end of the range, thinking maybe the longer term trend is going to take back over. So that's how you can kind of interpret this chart. And this chart looks like a lot of those charts we looked at. Looks like discretionary, looks like retail, looks like those failed breakouts we saw all across the market. And so it looks like some of those equal weights. So that's where I think you could buy, but not necessarily because we need more evidence to say we're going to resume back to new all-time highs, but we could get back to the top of the range. Where then if you saw a weakness, you would then sell. So as long as we stay in this rangy market, you kind of have to be a rangy trader. Talked about this bond chart. Think that's another savior of the market. An area of the market that's doing really, really well that I think it makes sense to have some exposure to is healthcare, which we've talked about this for several weeks now. But healthcare looks really good, right? You've seen it from med devices. You've seen it in IHE, pharmaceuticals. Some would label those defensive areas of the market. I think JC made a great point this week. I would go to JC's work. He wrote about biotech and how biotech is doing a lot better this time than it was doing during the 20% drawdown we had earlier in the year. So I think healthcare is something you can allocate to at this moment with this breakout against 150. You have a little tight flag and you can allocate to a breakout here. It can't save the market, but it's just one of those charts that I wanted to share because I think if you are looking for allocation and you do have to put some money to work, healthcare is an area of the market that's holding up. So So with that, guys, that is the show today. Like I said, I'm going to do a Thompson's 2 cents Q&A next week. So leave me some tickers in the notes. And also let me know, what do you think is ugly in the market? What do you think is messy? And what do you think the savior is going to be? Do you guys think it's going to be these bonds? Do you think it's going to be the Fed? Right? Do you think the Fed kind of lowering rates can kind of help put the pressure off of housing? Right? We look at that housing chart. Can that do it? Can that be what we need? Because right now, this is just RSI oversold bouncing, which we've seen, right? That's a dead cat bounce to a degree. So I want to see follow through here. I don't think it's necessarily the time to be taking shorts. Next week, we see some follow through. Maybe you trade the bottom of those ranges. But with that, guys, those are my charts. Hope you guys have a great weekend. Shout out to everyone in the chat. Thanks for joining. Shout out to Grant. Shout out to Fred. Shout out to LFY. I appreciate you guys. Appreciate the love. Give this video a like and a comment. And with that, Gene, we can take it out. Peace.